Well, good afternoon, everyone. It's 12:01, and we see we've got quite a few folks on already. More may be joining, but we've got a lot to cover. We'd like to go ahead and get started. So I'll introduce myself. My name is Alex Mattera. I'm a partner here at Pierce Atwood in the Restructuring, Bankruptcy, and Creditors' Rights Practice Group. And we're here to present this third of three sessions today. Sticking with our storm motif, this is the storm and recession aftermath. This is FEMA coming in with cleanup. So many of you have been attending other sessions. We will be making the slides you're seeing today available. They'll be emailed out to all participants, all registered attendees, probably by tomorrow, but they're also available on our website. If you visit the main page, pierceatwood.com, scroll down to events, they're arranged by date. Find today's date on May 20th, you'll find today's program, and also links to the other two sections of this program. The first session was batten down the loan documents and collateral. The second session was forbearance and early stage workout strategies. And today's the third session, bankruptcy, foreclosure, and collection, or as we like to think of it, ready, get set, recession. And today to talk about recession, I'm going to turn it over to and introduce my partner, Keith Cunningham, to take us through what we're seeing and what you should be looking for. Keith.
Thanks, Alex. Well, welcome everybody, and thank you for joining us this afternoon. Like Alex, I am a member of the Bankruptcy and Creditors' Rights team here at Pierce Atwood. I chair the business practice group, and I've been at this since 1988. So unfortunately, I suspect it's our fourth recession since I started practicing law. And one thing that we can say is, while each recession is slightly different, there are also some patterns that you tend to see out of each recession. So looking here at our first slide, you can see insights from historic and current data. And one of the things that's a commonality in bankruptcy filings is that bankruptcy filings, foreclosures, mortgage delinquencies, they track unemployment rates. And that's a little bit frightening right now, as you might imagine. The Congressional Budget Office projects unemployment for the second quarter to be 15%. We're looking at 15% again for the third quarter of 2020. And in the fourth quarter of 2021, CBO projects unemployment to be 9.5%. So this could be a very long and painful trajectory and a very large increase in bankruptcy filings over the next year to year and a half. If you compare those unemployment rates to the Great Recession from 2008 to 2010, unemployment at the beginning of that recession was 5%, and it rose to 10%. So this really could be quite a historic, in terms of bankruptcy filings, an historic event. A second thing that's common to recessions is that lending tends to tighten. And so you might say, well, how is that going to affect this recession, and how does it affect you as a lender under the current circumstances? And one of the things that I think we're going to see here, pulling out the crystal ball, is that if that holds true to form, we're going to see highly leveraged businesses with good fundamentals increasingly seek bankruptcy protection. Access to capital will be key, and if the small businesses and medium-sized businesses that are your borrowers are able to obtain access to capital and can ride out the storm, maybe that will dampen the bankruptcy filings. On the other hand, if credit tightens, as it traditionally has, even those businesses that have good fundamentals and may be able to weather the first part of the storm, we may find that they have some difficulty if there's a second shutdown that comes along. And then last, we're going to talk a little bit about who are the debtors. And, you know, it's obvious that restaurants and retail and hospitality industries are affected. No question about that. But one of the things that we do want to keep in mind is that at least one commonality among the last three recessions, and each of them did have a particular focus. So real estate in the last recession, back in the late 80s, early 90s, the focus again was on real estate, and that's when the banks in northern New England in particular had difficulty and were taken over. Here, the common thread will be hospitality, tourism, retail. But there will be spillover effects, and that's something that we've seen from all of the recessions. So if you have a borrower that is heavy on rental property, particularly if the rentals are retail oriented or hospitality oriented, or bars and restaurants. That's not a good sign, and we do expect to see that the spillover will be particularly felt by those who have rental properties. Now, having just spoken about what the commonalities are, there are some differences as well. And so I'm going to turn it over to Alex, and maybe he can talk about some of those differences.
Thank you, Keith. So it's been attributed to Mark Twain that history doesn't repeat itself, but it often rhymes. And we've got a lot of rhymes in this sequence where we're seeing a lot of the indicators telling us what's coming. But we also have some key differences. And unlike the financial crisis in 2008 specifically, we're not seeing the business failures driven by tightened credit markets necessarily. So in 2008, we had what were sound businesses that were being impacted because of lack of credit, and an otherwise successful business was running into a crisis. In this recession, we're really seeing the opposite. We're seeing business shutdowns. We're seeing operational obstacles due to, of course, the lockdown, due to the disproportionate impact on hospitality industries and service industries. And we're seeing that despite what looks to be still robust credit in the markets. There's still a lot of availability. There are a lot of folks with funds that are eager to get into the market, and they're eager to provide rescue capital to businesses, but we're seeing businesses that simply can't take advantage of it. We're also seeing an unprecedented level of governmental involvement. Certainly with the PPP loans and other loans, we've got what effectively looks like a charge account for businesses, the way we've staved off consumer bankruptcies because of the availability of consumer credit. People don't tend to file until they've run up their charge cards and they have no more credit available. We're seeing now businesses in the same position. So we've got an inversion of the credit crisis leading to failing businesses. Now we've got failing businesses that we ultimately expect to lead to a credit crisis. We also have difficulty using our past recession experience to forecast what's going to happen in this recession. We have an unprecedented health crisis with no clear understanding of when that crisis is going to be over or what the landscape will look like once it is. And the lack of visibility into cash flows and projections is going to cripple banks' abilities to make loans on an informed basis with any expectation of the future performance of those company borrowers. So that's presented a new obstacle together with, again, that impossibility of determining when this crisis will end and when these markets will start to revert to normal. So in order to underscore that, we're going to take a look at some current and past bankruptcy data and insolvency data to try to get a sense of where we're likely to head and what you should be looking for in that process. And I'm going to hand it back to Keith to start that.
So this slide's a really interesting slide because what it shows is how the bankruptcy filings have tracked unemployment. And if you look at this slide, you'll see in the gray line, that's near the peak in 2010. You'll see in the middle, almost 17%. Now, this is not the unemployment rate that's the official unemployment rate. U6 is an unemployment rate that adds workers who are part-time purely for economic reasons. But the official unemployment rate, which is U3, really follows the same pattern. And what is really somewhat interesting when you look at this bar chart here, this graph, is the length of time it takes for the economy to recover or bankruptcy filings to come back to pre-recession levels after a recession. So if you look at this graph, you'll see 2006 it is bottoming out after the 2001 recession. It spikes back up again 2008, 9, and 10, and then the bankruptcy filings slowly decline. And it's not until about 2017 or 2018 that you actually reached pre-recession levels for bankruptcy filings. So really one of the keys in this recession will be how long do we have sustained high unemployment? And if the employment numbers can rebound quickly because businesses open quickly, then it may not be as painful as what some are predicting. On the other hand, if unemployment remains at high levels through all the way into 2022, and 9.5%, as a reminder again, at the end of 2021 is what's projected, then you're looking at unemployment levels and bankruptcy filings even into the end of 2021 that might be equivalent to what you saw during the height of the Great Recession back in 2008, 2010. If we go to our next slide, mortgage delinquencies and foreclosures, you can see that the shape of this graph is really very similar to the shape of the unemployment in the bankruptcy filings. And that's because mortgage delinquencies and foreclosures, no surprise, follow very closely with the unemployment rate. And again, the real takeaway from here is, unless unemployment comes down quickly, we're going to be in for a very long and painful period in terms of mortgage delinquencies and foreclosures. You can see here in 2006, it's bottomed out after the 2001 recession. And again, not until 2017, 2018 are you back to where mortgage delinquencies and foreclosures are on par with pre-recession levels. So it's a long time to recover, and unemployment will really be the key here in terms of how quickly can bankruptcy filings come down and how quickly can mortgage delinquencies be abated. We go to our next slide, and this is an interesting slide that was prepared by the Federal Reserve Bank of Boston. And what it shows is the total value on a monthly basis of mortgage and rent defaults for the New England states. And not surprisingly, Massachusetts has the highest, but perhaps somewhat surprisingly, Massachusetts accounts for about half of the value of all mortgage and rent defaults. This slide shows what those mortgage rents and defaults would look like without any unemployment insurance expansion or direct payments from the Federal CARE Act. And then if you go to the next slide, this is how those figures change based upon unemployment insurance, based upon reopening and other stimulus. And those numbers dramatically fall. So if you look at the black boxes, you'll see that just looking above Massachusetts, roughly 35% for renters, roughly 17% for homeowners are at risk. And if you layer over that stimulus, unemployment insurance and the CARES Act payments, those numbers drop dramatically. In the Massachusetts homeowners column, you'll see a red box. That's 5%. That red box signifies if 95% of all eligible recipients took part in the unemployment insurance that's been offered or received a $1,200 CARES payment. And if you go up to the, if you go up to the 5% box, that's actually 75%. 3, which is the green triangle, would be 95% acceptance of benefits that they're eligible for. So really, government policy is going to make a big difference here. And the question will be, if we have a second shutdown, will our government be able to support homeowners and renters again through either another expansion of the unemployment insurance or through additional direct payments to homeowners and others, depending upon income levels? And if the government is not able to provide that type of stimulus, then that's going to have a dramatic effect on the defaults that you'll be seeing among your borrowers. Moving to the next slide, tightened credit, we talked about that before. And the problem with tightened credit is that it's going to reduce the supply of funds that are available to businesses at a time when you most need them. And this was a study done by the St. Louis Federal Reserve back in 2016. And what it shows is once the recession hits, there's a very distinct tendency of lenders to tighten credit. So while we right now have a wide availability of credit, both through private institutions as well as through the federal government, the prognosis is not good if we follow the pattern from the last 3 recessions, which is credit will tighten, and that will drive more businesses to reorganize. And again, if there's a second shutdown, that's going to have a dramatic impact on the number of businesses that can survive because those cash reserves that they have today or the access to the line of credit that they have today, that line of credit may be completely used up if there's a second shutdown. So that's just something to be looking out for. What will happen to businesses going forward, and will there be more orders in the New England states that effectively result in a lockdown of businesses? To show what bankruptcy filings might look like, I'm going to turn it over to Alex, and he can go over the next slide.
Thank you, Keith. So there's a lot of data in this slide, but what we've tried to capture here is a comparison between this impending recession and the two prior recessions. Now, let me orient folks to the chart. We've got the first section is labeled March 2002. The second is March 2010, and of course, the last is March 20. What we're looking at in the first two are the 3-month periods that essentially followed the peak of the recession's beginning and even starting to come out. So what we tried to target was not the chaos, not the eye of the hurricane when the recession was building, but what did the aftermath look like as we were just starting to climb out of it? And that's what we're looking ahead to today, of course, in this seminar. But what we see in the prior two is that 3-month period, which you'd want to forecast out for the entire year, you'd multiply that by 4 to give you a sense of what the entire year would look like. We had bankruptcy filings, for instance, in Massachusetts, business Chapter 11s, approximately 60 cases filed in the first quarter of 2002. Over the year, that could expand out to 240 cases if they were on pace. March 2010, we saw 44 cases filed. That would expand out to something like 180 cases for the year. So fairly big numbers that we haven't seen since probably the early 90s for bankruptcy as a reorganization vehicle for troubled companies. We've certainly seen a move away from that. And this seminar is not to talk about bankruptcy trends generally, but to talk specifically about this recession. But for a variety of reasons, bankruptcy has not been the go-to reorganization strategy for companies. When we see numbers this high, it means something exceptional is happening. Now we look at March 2020, and we look at that first quarter, which reveals filings for businesses, already 16 Chapter 11s in Massachusetts. You take that number out through the rest of the year, and it's going to quickly rise. We're going to see considerably higher filings than we've seen for a number of years, certainly since the end of the last recession. And we're expecting that number to increase. These are numbers from all of the First Circuit. So we're seeing most of New England. We've taken Puerto Rico out of this. That skews the data, probably double these numbers, but it's an entirely different economic climate. So we're going to exclude those for the purpose of this. But we can see that we're on pace to have a real swell of filings, probably on the order of 3 to 4 times what we see in this chart. So for the year, we could be looking at filings even that exceed those in 2010, possibly that exceed those in 2002. But of course, these are just numbers, right? We've got a chart full of data that tell us the number of bankruptcies. They don't tell us where in the economy those bankruptcies will be. I'm going to turn it back to Keith to talk about which industries are we expecting to make up these numbers as we go forward into this next phase.
So we go to this slide here, and if you look in the column that is titled March 2009, what you'll see is the share of total unemployment insurance claims by state, and the 3 states going across the top, Maine, Massachusetts, and Vermont. I'll focus just on Maine since it's the closest column to the left side. And one of the interesting things about the recession in 2008-2010 was that notwithstanding the fact that it was a recession that was caused by a credit crunch, and the mortgage industry really is where a lot of the focus was, it was a broad-based recession. And so when you look at the columns here, you'll see unemployment insurance claims were just as prevalent in service industries as they were in construction. and manufacturing was hit. And transportation, was really the only major industry, transportation, agriculture, and utilities, that avoided the consequences, or at least had minimal consequences from that recession. What's different here is the concentration in service industries. And if you look at the column March 21 to April 4 of 2020, you see the UI claims for Maine, 36.4% in the service industries. No surprise to anyone, restaurants shut down, hotels aren't able to book guests. But that is very different from what we've seen. And so to the extent that you have portfolios that are heavy on retail or hospitality, tourism, particularly for the Maine economy, where tourism is the #1 industry in the state, it really is a discouraging number to look at to see the impact on unemployment insurance, particularly when we know that unemployment insurance claims are a precursor of bankruptcy filings. If we move to the next slide, this is really a question of, is your borrower built to weather the storm? And this slide just really graphically depicts the impact that the shutdown orders in various states have had on just one industry, the hotel industry. In Maine, the governor has entered an order that requires anyone coming into the state from out of state to quarantine for 14 days. And as you might imagine, for the hospitality industry in Maine, that's the same thing as saying you need to shut down for the summer, because the average stay in Maine for a tourist is 4 days. So there will either be a lot of non-compliance with that executive order from the governor, or hotels simply won't be able to book guests in Maine. Perhaps a little bit different from Massachusetts, where a lot of people escape to the Cape. But if you read the Boston Globe, there's a lot of chatter in Provincetown and the other towns out on the Cape as to whether they should shut down during the summer and allow tourists into town or not. So it's a real question here: is your borrower built to weather the storm? And the things that you would typically look at may not apply here. You're going to look at cash reserves and access to credit. You look at cash flow. You look at the fixed costs and what the leverage is for the business. You'll look at the ability of the business to remake itself, as an example. You might look at the dependence on in-store versus internet sales. You might also look at traffic to the store. If you have a retail establishment downtown in Boston, it might be a much different analysis than if it's a local store out in Western Massachusetts. Large employers in Massachusetts are saying that many, especially the white-collar jobs, those employees will stay at home for the summer. And so you reduce the traffic downtown, you're going to reduce the sales. So those are all factors to consider. But as Alex had mentioned in one of the earlier slides, the one unknown here is what's going to happen. Will there be another shutdown? And while a business may be built to weather the first shutdown, it may not be built to weather a second shutdown. Let's take a look at some of the recent Chapter 11 filings, because they're also helpful in trying to figure out where the problems may lurk and what you can do perhaps proactively to mitigate some of the damage that might come up.
So turning to this slide, you see a kaleidoscope of recent Chapter 11 filings. When we began to prepare these slides a few weeks ago, half of these companies would not have appeared on this slide. It has been such a fast-moving development that we're reviewing and adding companies to our list on nearly a daily basis. These are, of course, large retailers, folks who are impacted by the hospitality issues, airlines. We've got gyms. Gym memberships have just taken an absolute beating because of the inability to stay open and allow folks to use their service. Certainly restaurants and these large box retailers. And then we've got the cascading effect of these retailers and restaurants and gyms going out of business, affecting obviously their lenders, affecting their landlords, affecting their vendors and suppliers, and as we saw with unemployment, affecting their workforce. So this will continue to develop into a pattern where we see more of these types of businesses, and then the longer this goes on, the more we start to see other types of businesses as sort of the second wave of collateral damage to these. So what do we take away from this? We look at what we're recommending to our clients and certainly what any lender should be thinking about. Be proactive. The last two sessions really focused on some of these issues, but they're worth repeating here. So when you're assessing your risk, you're looking at who are your borrowers, who you're lending to, what industries are you lending into? Do you have manufacturing? Do you have equipment loans? Do you have construction lenders loans on projects where you're likely to not be as deeply impacted as if, for instance, you're lending to restaurants and franchisors? So knowing where you are you in a state that relies on hospitality like Maine and Vermont? Are you in a state that's got a broader base of income and production that's going to have an easier time weathering these challenges? And then you want to be thinking about not the objective, but the subjective. What about your loans? What about the documentation? What about the state of the collateral? We talked a lot in the first session about preparing by reviewing loans, being sure that you've perfected your interest in your collateral, being sure that there are no mistakes. And then we talked in the second session about using this tightening market as an opportunity to clean up any issues you might have. Are you entering into a forbearance agreement? Is that the place to reiterate and possibly correct any deficiencies in your loan documentation? Do you want to make sure you know where your collateral is, what condition it's in, who else has potential interests against it? This is a time for very tight controls and monitoring of your borrowers. This is not a time to check in once every quarter, once every year to see how they're doing, but take advantage of those covenants and those responsibilities in your loan documents for borrowers to provide financial information, to pull statements, and to take a real close scrutiny to each of your accounts. As Keith talked about in the last couple of slides, who's built to weather this storm? We're extending our storm analogy. Who's going to come through this and who's going to be dashed on the rocks of insolvency? That really goes to this unique situation where we've got so little margin in the current financial circumstances for mismanagement for companies that maybe don't have their business fundamentals lined up. Ordinarily, there's a little bit of play. We've had very robust markets. We've had broad availability of credit, and we've had companies that maybe could be a bit sloppy with their management and their fundamentals. We don't have that now, and we're going to have that even less going forward. So keeping a tight control on the business and knowing that management in place is keeping a tight control is critical. How capitalized are these companies? Are we entering into forbearance and workouts? Certainly, if we are, then other lenders will be, other creditors will be. And then you want to have a sense of who are you competing with against the assets and operations of this company? What's their creditor mix? Because just as much as they are borrowers and indebted to their lenders, in turn, they become lenders in effect to their vendors and suppliers and customers. And you want to have a sense of what's their debt ratio, what's their mix, so that you know whether it's going to be collectible. This is an opportunity to also underscore what we mentioned a couple of times in the slides and verbally. If you've got borrowers who are dependent on cash flow from rentals, who are landlords to these big box stores, if you're determining your ability to lend and their ability to borrow based on their cash flow, you need to be mindful of the risk of them losing their tenants, of tenants coming back from this lockdown at a reduced capacity as people have adjusted to working from home. And that's going to dramatically impact their ability to bring in that income and to service the debt to you. So having a sense of what their own debt mix is going to be important as you monitor these loans. So turning again back to Keith, where we talk about your ability to weather this and the company's ability, how do you determine whether you're able internally to do that, Keith?
Sure. We are going to have a bit of a lull before the storm. And again, a lot of that will be determined by government action, the extent to which capital is made available to businesses. We've seen it through the PPP and as well to the workers themselves through unemployment insurance benefits being enhanced. But internally, now's the time to be thinking about when that storm does hit, are we adequately staffed? Are we adequately trained? There is going to be this lull, and taking advantage of it now really will be important. Because when the storm does hit, depending upon how severe it is, and it could be quite severe, and really almost unprecedented since the Depression, the demands of just trying to keep up will make it very difficult to staff up at that time and to train folks adequately to deal with the mess that we may be dealing with. The same holds true to looking at your internal processes and your systems. And they may function now, but will they function under stress? Bankruptcy moves very quickly. And when a bankruptcy is filed, if it's a Chapter 11 case, there'll be a series of motions will be filed on that first day. You may have a collateral position, but there may be a DIP lender different from you. And that DIP lender may be seeking rights and remedies that would impair your position as a secured creditor. They may be seeking super priority administrative expense treatment. They may be seeking a priming lien. So you'll need to be able to jump into action very quickly in some cases, and having an adequate notice system in place and a calendar system in place, because deadlines in bankruptcy, there's very little wiggle room. If you miss a deadline, you generally have missed that deadline and can't do anything about it. It's important now to look at those systems and make certain that you're comfortable that when the storm does hit, that you'll be in good shape. And then last, everyone's going to be looking at their reserves, but it's probably not a surprise or not a great prediction to tell you that restaurant equipment, as an example, is not going to be worth in 6 months what it is worth today. And so we're really taking a look at the collateral that you have. And in some cases, those collateral values may hold up quite well, but in other cases, particularly retail industry and in restaurants and bars, that collateral, there's just going to be a glut of it on the market. There's just no two ways about it. Not all restaurants are going to be able to survive this. And so taking a look at your collateral and making sure that you've adequately reserved, and you may have a fairly large unsecured portion of your claim will be important going forward. Alex, I'm going to turn it over to you, and maybe you can talk a little bit about the different chapters in the bankruptcy code that folks can seek relief under.
Thank you, Keith. So we've got at our firm, this is my third recession, and we've got a bench that goes deeper back, probably 5 recessions altogether. For some of the bankers in our audience today, you may not have been through a recession yet. We're already 10 years out of the last recession, and we have enjoyed the longest recovery in U.S. history. So we're going to go through what might be familiar ground to some people, but is certain to be new to some others. The options in bankruptcy include Chapter 7, which is a liquidation, and then we've got 2 different reorganization chapters, and we're going to go through these pretty quickly. Chapter 7 is available for both individuals and businesses. It's a liquidation. For a business, that means the business ceases operating as soon as the case is filed and winds down. It also means that a trustee is appointed and management is no longer in control of the process. For an individual, the end goal of a Chapter 7 is a discharge. That means a discharge of all dischargeable debts. Without getting into the nitty-gritty of what's dischargeable and what isn't, most debts for an individual related to business debt are going to be dischargeable. For a business, there's not a discharge, but then again, when the business is wound down, ceased operating, and gone out of existence, that's largely a distinction without a difference. The business will no longer be operating. There's no ability to collect any money outside of the bankruptcy from that company. So a liquidation in Chapter 7 is a final event for most businesses. Chapter 13 is what you can think of as a reorganization on the individual, not business level. Individuals have a very simple reorganization process where they devote future income to plan payments to their creditors. Anything that's not paid through those plan payments is then discharged, similar to the way it would be in a Chapter 7. The difference, of course, is that there are partial payments to creditors in a Chapter 13, similar to the way there would be partial payments to creditors in a business Chapter 11. Typically in a 13, it would be a 5-year plan, and it allows the debtor also to term out mortgage defaults over the life of that plan. The eligibility for a 13, as we say here, is based on the amount of debt. There are limits. There's a ceiling to the amount of debt that's available to be reorganized in a Chapter 13, outside of which that individual is pushed into a Chapter 11. So Chapter 11 is available to individuals and businesses. Businesses cannot file a Chapter 13. They reorganize through Chapter 11. The chief benefit to filing bankruptcy for a business or an individual in a reorganization is it buys them breathing room. It buys them time to get their legs under them, figure out a reorganization strategy, and implement that strategy. They do that through a plan of reorganization that gives some fairly broad powers to the debtor to be able to take some changes to their debt and to propose some unusual terms for its repayment. We'll be going into those in more detail, so I'm just touching on that here. The important thing to consider in an 11 is that the debtor stays in control. There's not a Chapter 7 trustee. Debtor management typically stays in place and runs the case through the bankruptcy. Bankruptcy through Chapter 11 can be expensive and can take a considerable amount of time. Because of that, it's long been a bar to smaller companies because they just can't afford the administrative expense and time involved in the process. The newly enacted Small Business Reorganization Act has provided and expanded that relief to these small businesses. Again, we're going to be talking more about that, but it generally lowers the bar to the bankruptcy filing and creates what we think of as a Chapter 13 for businesses, a streamlined approach that provides broad powers to the debtor, leaves the debtor in control, and allows the debtor to take action almost without regard to objections by lenders and other parties in interest. But for many of our lenders, we're going to see the most interesting issues come up in a Chapter 11. So we'll focus on that. And I'm going to turn to Keith to ask a question of, what happens in Chapter 11? What's the success rate look like for these companies?
Well, it's not good. If you look historically, less than a third of Chapter 11 debtors emerge from Chapter 11. Let me orient you a little bit onto this slide. If you look at the inner circle of the chart there, you'll see statistics for 1989 to 1995, and then the outer circle is 2008 to 2015. A couple of takeaways. Back in 1989 to 1995, fewer bankruptcy cases were dismissed. The more common occurrence was for a Chapter 11 case to be converted to Chapter 7, and a Chapter 7 trustee would then liquidate the assets. More cases being converted meant that there was more supervision so that lenders could at least be sure that there was a Chapter 7 trustee looking over the debtor's shoulder to make sure that assets were being realized, that they weren't being hidden. You spin forward to 2008, 2015, and as Alex had said, bankruptcies become very, very expensive and very complicated. And so the old days, going back to 89 to 1995, you could actually have a reorganization, and a reorganization with a smaller business. Moving forward to 2008 to 2015, it has become so expensive under the existing regime that it's very difficult to ever reorganize a business. In most cases, the assets are sold, they're just sold in a Chapter 11, in what's called a 363 sale, which is just a reference to the provision in the Bankruptcy Code that allows sales of assets free and clear of all liens and encumbrances. So one of the questions that we had is, will the new legislation that was approved by Congress creating a Small Business Chapter 11 have any impact on the declining utility of Chapter 11 for businesses? And Alex, why don't I let you take the next slide and go from there?
Thank you, Keith. The Small Business Reorganization Act definitely promises to change that trend. What we're looking at in this graph is business bankruptcy filings, which you can see going back into the 80s and following through various recessions and ups and downs, have consistently been on a downtrend. For all the reasons that Keith just described, we've seen fewer and fewer corporate bankruptcy filings, certainly fewer successful bankruptcy filings. why do we think the SBRA is going to make a difference? So the SBRA has only been in effect since February 20th of this year. And of course, that timing was almost perfectly aligned with the current COVID crisis. And we're seeing already responsiveness to increase the availability of the SBRA. So what it is, it's created a new subchapter to Chapter 11, specifically available only to small businesses. And small businesses are defined as businesses with total debt originally beneath that $2.7 million cap. You see the figure on the slide. It's an odd number. It adjusts annually. It's just under $2.75 million in debt. That's both secured and unsecured. So a fairly low number when you take into account secured debt, but still a number that encompasses a huge number of companies, particularly in the restaurant, hospitality, and service industry. That number was increased, was almost tripled to 7.5 million as part of the CARES Act to expand that availability in anticipation of many companies needing to take advantage of this. There's no way to know yet, but we already are thinking that we'd be surprised if that didn't become a permanent change. I think it will largely depend on how many companies take advantage of this. But if we see a trend where a lot of companies successfully reorganize in that bracket between the 2.7 and 7.5 million, we're likely to see that remain in place, become permanent to make that available going forward. It is available to both individual and corporate borrowers. So individuals who are pushed out of a Chapter 13 because they exceed those debt limits normally would have to go into the regular expensive version of Chapter 11. This affords them the opportunity to squeeze into the new subchapter and to streamline and make much more cost-effective that process. They do have to be engaged in commercial or business activity. So an individual who simply has a high debt is not going to be able to take advantage, but an individual whose debts are largely driven by personal guarantees and corporate liabilities will be able to enter that, even if they also have significant personal debts, such as a home mortgage or other personal borrowings. The key differences to the small business reorganization provisions in Chapter 11 from a traditional Chapter 11 are what makes it so attractive. There's a small business trustee who's appointed in the case, but the debtor still remains in control of the case. The trustee is there for oversight, but not necessarily for control. No creditors committees are appointed. In a traditional Chapter 11, a creditors committee would be appointed. That committee would then engage its own set of professionals, which largely duplicate the effort of the debtors professionals and maybe compete with the efforts of creditor professionals on the secured lender side. No committees in subchapter 5 means a whole level of expense eliminated. No quarterly fees are due to the U.S. Trustee's Office the way they would be in a traditional Chapter 11. And perhaps most importantly, the debtor has an exclusive opportunity to produce a plan and to seek approval of that plan without competition from other parties. It's a short period. There's a 90-day deadline to get that done. No separate disclosure process is required, so it combines the two in one process, thereby eliminating roughly half the hearings and pleadings involved. A modification of principal personal mortgages on residences is possible, which would not otherwise be. And most importantly, the debtor does not need to have an impaired class voting in support of the plan, and the debtor can confirm that plan over the objection of some of the interested parties. There's a lot of detail there. There are a lot of technical issues there. This is not meant to be a treatise that you can refer to as you navigate the plan process with your own debtors and your own claims, but it does point out all of the things that a debtor does not have to do in a subchapter 5 case that drives down the expense, the time, and eventually the likelihood of success. Every one of those obstacles provides an opportunity for a debtor to fail, as we've seen in the graph that Keith walked us through. Without those obstacles, the debtor has a much higher likelihood of success. Turn now to an alternative. We've been talking about bankruptcy, but in Rhode Island at least, and certainly in other areas to a lesser extent, there are alternatives to bankruptcy. We talked about sort of the pre-bankruptcy alternatives of workouts and forbearance agreements in prior sessions. Now we're talking about, you've definitely hit an insolvency issue. You definitely need reorganizational help, but is bankruptcy your only option? And as I say, at least in Rhode Island, traditionally receiverships have provided an alternative. And a receivership can be thought of, at least in a place like Rhode Island, where there's an established statute and an established practice, as a state court alternative to bankruptcy. Receivers largely operate as trustees do in a bankruptcy context. They often have similar or even extended powers. And in Rhode Island, we've seen a culture develop of a very robust receivership practice, giving rights of sale, giving opportunities to amend and alter mortgages, and most importantly, the ability of the receiver to operate the business and continue to earn income and service debt during the pendency of the receivership. It's not code-driven, although it's technically overseen by the state court. There's a lot less oversight than the federal process under a bankruptcy court judge with the United States trustee reviewing. And it often gives the secured creditor significant power to participate and possibly even to select the receiver that's appointed. But like everything in this post-COVID environment, traditional receiverships have been subject to change, and I invite Keith to talk about the ways that's developed, just as we've seen traditional lending and traditional enforcement develop.
Sure. I'm not going to spend much time on this slide, just paying attention to our clock here. We only have about 10 or 12 minutes left. But Rhode Island, insolvency is a business down there. And they could see, I think, handwriting on the wall that the new small business reorganization provision might impact their receivership business in Rhode Island. The Rhode Island courts started looking at, in response to COVID-19, a way to allow businesses that are solvent, meeting their debts prior to the pandemic shutdown, to reorganize. Receiverships in Rhode Island have traditionally been used in the case of liquidations. And so the court is now looking at creating a new process, a non-liquidating receivership that will be very similar to the new small business Chapter 11 bankruptcy provisions. But work is underway for legislation to document and statutorily allow these types of receiverships. But basically, this will be like the small business Chapter 11 bankruptcy provisions that were recently enacted by Congress, but with much more flexibility and with the same goals. And that is a process that is inexpensive, that is simple, and that is quick. So stay tuned, but for secured lenders, receivership can really be viewed as a strategic alternative, whether it's a non-liquidating receivership or the type of receivership that Alex just talked about. It can reduce expenses. It can allow a secured lender to stay in control, or at least have some influence over who the receiver will be. And when there are title problems, a receivership can be a really solid solution because it allows the court to approve the sale of the property and at the same time to quiet title. So it's an excellent option in Rhode Island. To a lesser extent, it's utilized in other New England states. And with that, I'm just going to move over to bankruptcy essentials. And these are just some of the basics of bankruptcy that those who haven't been through the process before, it might be helpful to give a little bit of background. And so the number one thing in bankruptcy is understanding who's on first base. And by that, I mean, what's the pecking order in claims? And of course, being a secured creditor is the key. If you're a fully secured creditor, then you're going to recover. And you may have to delay in payment, but ultimately you'll get your dollars. The problem in a market like this is that you may be fully secured today, and tomorrow you may be undersecured because of a decline in the value of your collateral. And now you're looking at having a deficiency claim, which is a general unsecured claim. And as experience teaches us, it's fairly rare, particularly in a recession, for unsecured creditors to receive very meaningful distributions in a Chapter 11 or a Chapter 7 case. It's usually pennies on the dollar. The second best place to be if you're a creditor would be that creditor that has super priority. That is, super priority is only for parties who are advancing generally only for parties who are advancing money post-petition. So sometimes you may be a secured lender, you want to keep your debtor afloat to reorganize. In that case, you would seek court approval to provide debtor in possession financing after the bankruptcy filing date. All the money that you advance after the bankruptcy filing date presumably will be secured, and at the same time, if there's a shortfall in the value of the collateral, what you would get would be a super priority claim saying that you recover money before anybody else. There's usually a carve out for debtors counsel and maybe a carve out for the creditors committee if there is one, but it's a good place to be. For lenders, priority claims, it doesn't happen. Those are the folks who are going to be ahead of your general unsecured claim, tax claims, unpaid wages, and the like. Equity, last in line, not the place that you want to be. So if you have a pledge agreement and an ability to exercise that pledge agreement, you have to really think long and hard about whether that's something that you want to do in a bankruptcy, because number one, equity is last in line to recover, and two, it can have spillover effects on how your other claims might be treated. So if you have secured or unsecured claims, it could have spillover effect on how those claims are treated. Our next slide talks about the automatic stay. This is just basic bankruptcy 101 here. The moment the case is filed, all collection needs to cease against the debtor. And that's an important point because the automatic stay only protects a debtor. Non-debtors are not protected, so to the extent that you have a guarantor of a loan, that guarantor is not protected. I will say there is one chapter in the Bankruptcy Code, Chapter 13, where co-debtors are protected, but in a Chapter 7 case or in a Chapter 11 case, you're free to pursue the guarantor without any need to obtain relief from the automatic stay if that guarantor is not in bankruptcy. Another point that's worth noting is that letter of credit rights. You are not protected by the automatic stay if you've issued a letter of credit for the benefit of a creditor or of a debtor. That claim is a claim by the creditor directly against you as a lender. So if your letter of credit reimbursement rights are not secured, even after the bankruptcy case is filed, a draw can be made against that letter of credit, and you're just going to then have a claim against the debtor for the amount of the draw under the letter of credit. Relief from stay is possible. It's beyond the scope of this webinar to go into the ins and outs of obtaining relief from this automatic stay. Let's just say that if you are bound by the automatic stay and you don't seek relief from the automatic stay, the consequences can be really quite severe and include, in the case of consumers, having to pay attorney's fees and potentially even punitive damages. And the last bullet is probably worth noting, and that is the request is generally made. We want a bankruptcy proof, whatever deal we have. We're working with somebody that may be filing for bankruptcy, and I'd like to get a bunch of waivers in my workout agreement. And the short answer to that is I am not aware of any way to bankruptcy proof a deal. We can work with our clients to put waivers into agreements. In some cases, they may be enforceable, but in the vast majority of cases, pre-bankruptcy waivers. So a bankruptcy waiver of the automatic stay, as an example, is not going to be enforceable. As I said, there can be exceptions to that rule, but by and large, those waivers aren't enforceable. There are a couple of other general concepts that Alex is going to run through very quickly, and I'll turn it over to him to do that.
Thank you, Keith. And we do see that we've got just a few minutes left, so we're going to run through some of these bankruptcy issues a little bit quickly. Some of them are technical. We do want to get to the last bit of material in the slides. So adequate protection. You've heard from Keith that your enforcement ability has been stopped by the automatic stay. So what do? Obviously, from the debtor's perspective, adequate protection, which is not defined in the bankruptcy code, means as little as possible. And from the lender's perspective, it usually means not enough. Typically, what we see are courts entering orders requiring debtors to protect lenders against the diminution of the value of their collateral. If your collateral is depreciating, if it's subject to the need for insurance, or if it requires any other kind of upkeep or maintenance to protect its value, the debtor is going to be paying you that amount. For oversecured creditors, typically that involves at least being sure it's insured and paying interest, if not paying anything further on it. What you're not going to expect to get are regular monthly payments in the contract amount. Those payments continue to accrue, but you're not going to be able to collect them at least until a plan is in place or there's some other disposition of the collateral. We also wanted to cover quickly cash collateral. First of all, banks should know what their cash collateral is. Is it rents? Is it receivables? Are you perfected in it? Assuming you are, prior to a bankruptcy, you're not really thinking about cash collateral. Your interest is rolling over into new amounts that are collected or accrued. Your interest is rolling over into proceeds. That's not necessarily true in a bankruptcy. And you don't want your borrower using that cash without your and the court's approval of that. Typically, you enter into an agreement with the debtor that provides for a rollover lien in newly created accounts or whatever other form that cash collateral takes, and some protections such as the debtor's commitment to a budget and your ability to get regular reporting to monitor it. The most crucial issue with cash collateral is keeping an eye on the debtor and making sure you know that it's not being used without authority and that the debtor is conforming to the agreement and the budget if it is being used with authority. So that is the biggest pitfall for a secured lender, is knowing that collateral is out there and protecting it. I also am going to turn it over to Keith to talk about some early bankruptcy events, some highlights of the early stages of the case. Again, we'll go through these quickly to cover our last bit of material on outside of bankruptcy and what enforcement provisions are available.
So again, when a bankruptcy is filed, an automatic stay goes into effect. It doesn't matter whether it's a voluntary bankruptcy or an involuntary bankruptcy, the automatic stay is in effect. And it's no defense for you to say, I didn't receive a copy of the bankruptcy notice of filing or the copy of the petition. If you have actual knowledge of the bankruptcy, you're bound by the automatic stay. You need to cease all dunning efforts. You need to stop all collection actions. If foreclosure is in process, you need to take care of that as well. You will receive a notice of the filing of the case, and it's going to provide certain information to you that's critical. Again, this goes back to our point about, are you adequately staffed and trained, and do you have appropriate processes in place for handling bankruptcies? Because that notice of filing is going to contain very important information, including the deadline for, potentially the deadline for filing a proof of claim, and as well when you can object to the discharge of the debtor or the dischargeability of a debt of the debtor. And it's pretty rare, I think, that lenders object to discharge or the dischargeability of a debt, but those are important dates to know. In a Chapter 7 case, the objection deadline is 60 days after the first date that's set for the meeting of creditors, and the first meeting of creditors is usually in the first 30 days of the case. For secured lenders in Chapter 11, really it's important to pay attention to those first day motions, particularly if you have an interest in cash collateral, because that cash collateral is cash that gets used and you're not going to see it again. So protecting your cash collateral is very important. And it's not unheard of to see debtors propose to use your rents to fund other properties to meet the expenses of other properties. And so that's something you really need to keep an eye on. And debtor in possession financing, again, that's something really to keep an eye on. If you're not the DIP lender, you just want to make certain that whomever is the DIP lender, that they're not impairing any rights you have as a secured party. Alex, maybe you can talk a little bit about the other two notices or early events in the case that are important.
Sure, Keith. So the 341 meeting of creditors, that's the initial meeting. That's your first opportunity to get face-to-face with your borrower. Sometimes you've never had that opportunity. So for lenders, it's a chance to check in, get confidence in the borrower's management, and to challenge that or raise issues. It's conducted by the U.S. trustee. All creditors can attend, but it's very typical to see the secured lender attend through counsel. The claims bar date, this is the date by which the secured lender would have to file a claim to share in any distribution. That would include any claim for any deficiency amount. So if you're fully secured, you're relying on your collateral. If you're not fully secured, this is where you assert that deficiency claim for the difference. We're going to move ahead only because we're very close to the limit. We're respectful of your time, and we'd like to cover our last section. And I'm going to turn back to Keith to talk about what happens to secured lenders in Chapter 11. Maybe the inverse question is, what can a debtor do to you in a Chapter 11?
Well, the debtor can do a lot in Chapter 11. Of course, they can adjust the interest rate on the loan. They can change the amortization on the loan. They can do a lot of bad things to a secured lender. So having somebody that is experienced in the plan process is really critical in this process. I'll just talk about a couple of things here, and really where the mischief comes in for the secured lender is how they classify the claims. If you have an unsecured claim, oftentimes the debtor is going to try and create an impaired class of claims so they can cram you down, as we saw in the Small Business Reorganization Act. Cram down can be done there as well. And they don't need an impaired class in the Small Business Reorganization Act cases. But in the traditional Chapter 11, you need one impaired class to accept the plan. And here, what the creditors will do is they will classify your deficiency claim separate from all of the other unsecured creditors, and that gives them the impaired class, and then they can try and cram you down. Voting, another place to look is oftentimes the deficiency claim really is outsized and outweighs all of the other claims, and that's another case where they'll try to classify a secured lender, the deficiency claim separate from all other claims, and that way the secured lender doesn't control the voting process, because as you can see in the slides, in order to confirm a plan, the debtor needs to obtain acceptance of one impaired class of claims, 2/3 in dollar amount of voting claims, 1/2 in number of voting claims. So it's that 2/3 in dollar amount of voting claims that the debtor's trying to play games with. Alex, maybe you can talk a little bit about what the treatment is of secured claims in bankruptcy.
Yeah, so in bankruptcy, as you heard from Keith, the debtor can start to amend and tinker with your loan agreement to change things like the term, the interest rate, and the most important and often the most surprising is that the debtor can also change the value of the secured interest. So when the case is filed, you fix in time the value of the collateral, and if that collateral is in a low cycle and is significantly lower than when the loan was made, the debtor's secured interest, I'm sorry, the secured creditor's interest could be limited to that new lower value. And that is true even if the collateral subsequently appreciates. The lender does not get the benefit of that appreciation. They're stuck at a lower level. So the debtor can strip the value down to the current value of the asset. They also typically will do things like lower the interest rate to what is arguably a commercially reasonable rate, but is certainly not the rate you'd offer a debtor in this financial circumstance. And they can amortize that rate out over usually extraordinarily long periods, 20, 25, 30 years, over a 5-year repayment plan with an enormous balloon at the end, which is a sort of typically Hail Mary refinance strategy, which may or may not come to fruition. So there's a lot of risk for a secured lender in that situation. Attorney's fees, interest, late charges, they're all possible if the secured creditor is oversecured. If the value is not there in the collateral, typically those are not going to be included and the lender will not be able to recover those from the collateral. They'll be part of that deficiency claim. The alternative to bankruptcy often is a foreclosure or the subsequent event in a bankruptcy where the lender's obtained relief is to go to foreclosure, which necessarily often involves eviction if the tenant is still in the space or if the borrower is also the tenant in the space. The key takeaway for the foreclosure process is that it's going to be different. Like everything under the CARES Act and under our various states' responses to this health crisis, there are changes to what is already a highly technical process, and there are changes which are evolving as we speak. So I'll ask Keith to address the overall CARES Act changes and changes in Maine. I'll turn to Massachusetts and we'll go beyond that to wrap up with some of the other New England states. Keith.
Thanks, Alex. So I'll just very briefly touch on this. As we talked about earlier, the coming bankruptcies will depend largely on unemployment and whether that unemployment rate comes down quickly or whether it drags on, so that we're seeing a lot of bankruptcies in 2021. One of the things that you see is that unemployment ends, bankruptcy is not filed until well after all available cash is used. So there's usually a run up in unsecured debt. one of the benefits to the CARES Act is the CARES Act has allowed homeowners who have federally backed mortgages to postpone their payments. And you can see in the slide here that if you're experiencing financial hardship due directly or indirectly to the COVID-19 emergency, there'll be a forbearance that's granted. And that forbearance is initially up to 180 days, but it can be extended to 360 days. This would include all of the FHA, VA, USDA, Fannie Mae, Freddie Mac loans. All those are federally backed or they're GSE backed loans. So one of the things I think we're going to see here is because of the ability of particularly lower income borrowers to take advantage of these forbearance periods, that it's going to postpone, at least for some period of time, a lot of the foreclosures that types of foreclosures that we saw back in the last recession. But again, all bets are off if there's not federal aid that comes to the rescue of homeowners, because once that 360 days expires, it could be a mess. In Maine, evictions and foreclosures are basically stayed. There are some exceptions on evictions. So if you have somebody that's destroying the property, the governor has included a carve out for that. And on foreclosures, at least right now, they're on hold until the end of May, but that could very well be extended by the court. And at least right now, we just know it's no foreclosure action in Maine until at least the end of May.
And a lot of what Keith has described for Maine is true for the other states. The short answer on foreclosure is it's more than likely stayed wherever you are, and it's going to be delayed, and the process is going to be slightly different than you're accustomed to. In Massachusetts, there's a temporary moratorium on foreclosures. That moratorium is extended through the earlier of August 18th or 45 days after the emergency declaration by the governor is lifted, but that can further be extended. And again, this is already a highly technical process, and these moratoria have made it even more technical and certainly require lenders to reach out to counsel to assist them in that process. What we're doing here is highlighting to you that there is a lot to be mindful of, and that you want someone fluent in this process to help navigate it, because it's changing on a day-to-day basis, state by state, with a variety of responses by each jurisdiction. And that's true also of the remaining states. I'll turn it back to Keith to look at New Hampshire and Rhode Island.
I think it's just really more of the same. In New Hampshire, there's a state of emergency. There are no evictions or foreclosures. New Hampshire is a power sales state, so it's a relatively quick foreclosure process as compared to Maine, where you have judicial foreclosures. So when that state of emergency is lifted in New Hampshire, I think foreclosures could occur rather quickly, but for, of course, the forbearance provisions that are in the CARES Act, and that may dampen the foreclosure activity in New Hampshire. And then for Rhode Island, more of the same. As you can see there, there's a 60-day foreclosure moratorium. It was a voluntary agreement by lenders in Rhode Island, but as Alex said, you just need to really stay abreast of what's happening in the individual states and the orders in the states, because there's a good chance that wherever you're operating, whether it's in the 4 states that we've covered here or outside of New England, you happen to have a borrower that has properties outside of New England, there's a good chance that there's some sort of eviction or foreclosure moratorium in effect. So I think that wraps up our slides for today. We would be happy to answer any questions that any folks have. You can email either myself or Alex. Our email addresses are here on the last slide. And as Alex had indicated at the top of our webinar, our marketing department will be sending out copies of these slides to all of the registered attendees. And as well, they'll be posted on Pierce Atwood's website. If you go to the events section of the website and then look under 5/20/2020, you'll see this particular webinar, and you can download the slides from clicking on that link. So we thank everybody for joining us today. We apologize for going over a couple of minutes, but we wish you all well in dealing with your borrowers, and hopefully you can minimize your losses and theirs as well. Thank you, everyone.
Thank you very much.